For those of you who may or may not be aware of Mat Sorensen, I had the pleasure of meeting Matt and his partner Mark from KKOS Lawyers at the Self-Directed IRA Summit. I think it's about 5 weeks ago now. And the information that I took away from the summit was absolutely incredible. It provided a foundation to both support our investor base as well as additional resources in the form of Matt and Mark and their weekly podcast and their books. Matt's a best-selling author of the Self-Directed IRA Handbook. For those of you who are in a self-directed IRA or solo 401k environment, I cannot recommend this book enough. For those of you who are considering it, it is the key manual on how to proceed with self-directed investing. A couple housekeeping items real quick. There is a chat bar and a questions bar in your dashboard. Please feel free. I'll be monitoring the chat and the questions throughout the presentation. Please feel free to ask any questions on there. We will open it up at the end, and I'll have Matt answer those questions near the end of the presentation. Also, we'll probably have a little surprise somewhere along the way here, so keep your ears peeled for that. Last, there is a handouts button in the dashboard, which has a PDF of the presentation today. Feel free to download that at your convenience. So without further delay, I'm going to have Mat Sorensen take over. Matt, the floor is yours.
All right. Well, thanks so much, Dave. Appreciate you guys having me today. And I'm very excited to be talking about my favorite subject, self-directed IRAs and 401ks, and how they can be invested into real estate. So I'm just going to go through the presentation. This is similar to what's in the handout section. So if you want to download a copy or print one and take notes on, that's a good option. And my contact info is on the slides as well. Now, before I get into the content, I am a lawyer, so I got to follow my own advice and give a disclaimer. Just keep in mind that this presentation is meant to be educational in nature today. Doesn't constitute an attorney-client relationship. Pretty much don't rely on anything I say. Seek out licensed professionals for your specific transactions. All right, now that we got that out of the way, let me just tell you guys a little bit about myself. I'm a partner at the law firm KKOS Lawyers. We have an office in Phoenix, Arizona, where I'm at. We also have one in Irvine, California, in Orange County, one in Utah, and one in Idaho as well. Our firm specializes in small business, real estate, self-directed IRA laws. We call ourselves the Entrepreneurs Law Firm. And we've been working in this area that I'll be talking about, self-directed IRAs, for about 12 years. And it's 90% of my practice is spent just in this area. I speak pretty regularly in the industry. RITA is the national association in the industry for self-directed IRAs. All of the major self-directed IRA companies in the industry are members of RITA. I'm part of their faculty that teaches their certification program called the Self-Directed IRA Professional Program. I'm in fact the primary instructor for that. I also have my own event, the Self-Directed IRA Summit, which was held about a month ago. And that's a full-day intensive training on self-directed IRAs for those who are out there using their own account, or maybe people who work in the industry who want to get an in-depth knowledge of how to use it. That is actually recorded too, so if you missed that, the recorded version is available on the Summit site, which is just SDIRAsummit.com. You can access it through my site. My book, which is what I'm most known for, is the Self-Directed IRA Summit. That is it's an Amazon bestseller. I've sold over 15,000 copies. Every major company in the industry has endorsed it or uses it for their employees as training. And it's also curriculum for the Retirement Industry Trust Association certification program. All right, before we get into what and how all this works and using retirement accounts in real estate, I just want to take a step back of why we're talking about this. There's $25 trillion in retirement accounts in the United States right now, and that's just an astronomical number. I mean, how many times do we say the word trillion when we're talking about anything? And I think it's really important to understand that, because this $25 trillion is, all of America's money in retirement accounts, but each of us likely have a small little sliver of that $25 trillion. And what are we doing to invest that money? For too long, I think the status quo has been, well, I don't know what to invest in, so I'll just buy a mutual fund, just so my money's in the market with my retirement account. Because that's what the financial services industry's told us. That's what your broker tells you. And that's what's really available. If you have an IRA at Charles Schwab or TD Ameritrade or Fidelity, that's really all that's available to you. But we want to talk about how this $25 trillion can actually be invested into real estate. This could be your real estate deals. This could be you using your little sliver of the $25 trillion to invest in whatever real estate deals and opportunities you find. Don't feel like you're stuck in the stock market. That's the first important point I want to make here today, is when we're talking about self-directed retirement accounts, we're talking about taking your account, moving it to a self-directed IRA company. So if my IRA is at Charles Schwab and I don't want to buy stocks and bonds anymore, I want to buy real estate. I want to buy a rental property. I don't want to invest in a fund that's buying an apartment complex. I want to buy notes. I want to do this off Wall Street type stuff. Step one is you got to move your account from where it's currently at, if it's at Fidelity or Charles Schwab, because those places sell financial products. They sell stocks, bonds, and mutual funds. They're financial services companies. That's what they sell. So the first step is you'll need to move to a self-directed IRA company. Now you can invest that retirement account, whether it's a traditional IRA, Roth IRA, whatever it may be, into an alternative investment. But this is a huge market. It's been growing very quickly. People who have decided to self-direct and invest in real estate has grown. It's probably doubled every 5 years for the past 15 years. It's really been we've seen a significant amount of growth in this area. But let's talk about why people are doing this. If I have an IRA, let's say, for example, and I buy Apple stock for $100 a share, and I then sell it for $150 a share, and I sell it in my IRA, I made a $50 per share gain on the sale of that stock. Now, one of the great benefits of retirement accounts is when you sell an asset like that, like stock, you make a gain. That goes back into your retirement account. You don't have to pay taxes on the gain. That's one of the perks of retirement accounts and why people use them to save for retirement. Now, the same deal works for real estate. Let's say I buy a piece of real estate for $100,000 and I sell it for $150,000. That $50,000 gain goes back into my IRA and I don't pay any tax on it. It's the same deal that I get for stocks. So that same investment gain that I make on a real estate deal can go tax deferred if I have a traditional account, or tax free if I have a Roth account, back into my retirement account. I don't pay tax when I sell that property for a profit, or if it's a rental property and I have rental income coming in, I get that tax free or tax deferred benefit that retirement accounts hold. So we're using that same concept that we all understand for stocks and mutual funds, that you don't pay taxes as you're making money and growing the account. Now, there's lots of different ways to do this. You could have an investment property that's a rental. Either the retirement account owns the property directly. It could maybe own an LLC by itself or with other investors, or maybe a limited partnership that owns a bigger property like a apartment building or a commercial deal. Your retirement account could own notes that are secured against real estate. It could have options on real estate. There's lots of different ways to invest in real estate. And these could be residential, commercial. The one thing you cannot do when it comes to real estate with a retirement account is you can't buy assets for personal use. So I couldn't use my IRA to go buy a beach house that I'm going to use every summer myself, or to buy a cabin I'm going to use, or to buy, my residence. Whatever real estate your retirement account buys, it must be held for investment purposes. It's got to be investment property. It can't be something you have personal use of. That violates some of the rules. Now, when retirement accounts were created, a lot of people are like, I've never heard you could do this. When did this change? When is it that you could own real estate, or you could own ownership in an LLC that owns real estate? I thought you could only buy publicly traded stock or mutual funds with your retirement accounts. Well, actually, retirement accounts have always been able to own real estate, ever since they were created, like 30 years ago. The issue is the companies in the industry that administer retirement accounts traditionally have been financial services companies. They're broker-dealers mostly, so they sell what, they let your retirement account buy what essentially they sell. But retirement accounts have only had a few restrictions on what they can own, and here is what they are. First, retirement accounts cannot own collectible items. So you can't own like a wine collection or an art collection or a stamp collection. When retirement accounts were first created, you actually used to be able to own some of these things, and people were using their retirement account to buy art, but then they'd hang it on the wall at their house and it would disappear, or they'd have a coin collection and then no one can remember what happened to the coins, or they'd buy a wine collection and then the wine collection turns into a bottle collection. And so there's just a lot of abuse with collectible items. So the IRS came back, and through Congress they said, all right, no more collectible items. There's too much abuse. Then the other thing they restricted was life insurance. Retirement accounts, you just can't buy life insurance with your IRA. I don't think anybody came here to do that, so let's not worry about that. And then the next one is S corporation stock. IRAs just do not qualify as S corporation shareholders. A shareholder for an S corporation must be an individual. It's kind of an S corporation rule. So IRAs just don't qualify for that. But IRAs can own LLC interests that own real estate. They could own a limited partnership. They could own a C Corp. Any of those things are fine, and LLCs are very common for people who use self-directed IRAs. We're going to talk about that. The only restriction you have is S Corps. Now, what you can buy in real estate is it's a big open game, because everything's fair game except these three things here. One of the key things to understand, though, is something called the prohibited transaction rules. And this is a rule that has to deal with whom your retirement account can transact with, not what your retirement account can buy. And we're going to break that down in a second here a little more so you understand that prohibited transaction rule. But here's a quick diagram that outlines how a self-directed IRA works. The first thing to understand here in this diagram is the IRA is totally separate from the individual. So if I want to buy property with my IRA, I'm going to have the IRA on the contract to buy the property. It's not Mat Sorensen buying the property, it's my IRA. So if my IRA is at ABC IRA custodian, then the name on the purchase contract is going to be ABC custodian FBO Mat Sorensen IRA. That's going to be the buyer on the contract. It's not Mat Sorensen buying the property. It's my IRA. So I got to list it in the name of my IRA, which would be the name of the company I'm using, FBO Mat Sorensen IRA. Now, when I buy the property, the money's got to come from the IRA. There's expenses on the property, the IRA needs to pay for them. When there's rental income, the rental income goes to the IRA. When there's expenses, the IRA pays for it. And this could be the same thing with a note. IRA owns a note, the IRA would be the lender on the note. The IRA receives the interest and principal payments on the note. If there needs to be a collection activity, the IRA would hire a collection lawyer to go chase down the borrower on the note. So the key here I want to make sure everyone understands is the IRA is the owner of the investment, not you personally. You're directing the IRA and telling your custodian what to do, but you don't own it. Your IRA does. And your IRA receives the benefit of the income from that investment and also pays the expenses on that investment. Now here's another diagram showing how this works. Let's say I set up a self-directed IRA here. I can make annual contributions of $5,500 a year. If you're over 50, you get an extra $1,000 on that. But you can also roll over money. And most people who self-direct an IRA form it from a rollover from an existing IRA they already have, or maybe an old employer 401k that gets rolled into the IRA. Then that IRA can go and make investments, or it can invest in what we call, excuse me, an IRA LLC, and the LLC in turn owns the investments. We're going to outline this here in a minute, this part of the equation, but so far we're over here. The IRA is funded by contributions or rollover of existing dollars. Now this is not taxable. Let's say you have an old employer 401k at Vanguard and you want to roll it over to a self-directed IRA. That is a non-taxable move to roll over that money to the IRA with the self-directed IRA custodian. Or let's say it's a Roth IRA you have with a broker. You could roll over that Roth IRA to a self-directed Roth IRA and then invest it from the IRA, the self-directed IRA, which is tax-free. Now self-directed is just an industry term, by the way. There's no, from the IRS's perspective, there's no such thing as self-directed. Self-directed just really means you can invest in whatever investment is allowed by law. You direct what can be invested, as opposed to your custodian just giving you some fund options. So a self-directed IRA is just kind of an industry term. And it could refer to a Roth IRA or traditional IRA, SEP IRA. All right, we're going to go through a couple of transaction structures that are common for IRAs. But before we do, I want to break down the prohibited transaction rules here just briefly. What Congress did when they created retirement accounts is they realized, you know what, these are tax-preferred accounts. In a Roth IRA, they're totally tax-free. And because of that, we're worried that people are going to abuse IRAs and try to use them to avoid taxes in their personal life or to personally benefit from the IRA. So what they decided to do was restrict certain people from transacting with the IRA. For example, they don't want me personally transacting with my own IRA. So what they said is it's a per se prohibited transaction if an IRA engages in a transaction with someone who is a disqualified person. And a disqualified person includes the owner of the IRA, their spouse, their kids, their parents, their spouse's kids. Those people are all disqualified to an IRA. So if you take Mat Sorensen's IRA, take my IRA, and let's say my dad has a piece of real estate he wants to sell. And let's say it's a duplex he wants to sell. I can't use my IRA to buy that from him because he's a disqualified person to my IRA. Congress created the list and said, we essentially don't trust this person selling an asset to your IRA. They're too close of a family member. We think you're going to manipulate the transaction somehow to unfairly avoid tax. So my dad is just restricted. On the other hand, though, let's say it was my sister that had a duplex, and let's say my sister wanted to sell that duplex to my IRA. Well, now my IRA is buying a duplex, which is fine, and it's from my sister, and that's okay. Siblings, brothers and sisters, are not on the list of who is a disqualified person. So the first thing to understand is we don't want IRAs to transact, buy or sell, pay rent to, receive rent from, loan money to on a note, any of those things with a disqualified person. So don't have an IRA engage in a transaction with a disqualified person. And remember, disqualified person includes the owner of the IRA, their spouse, their kids, their spouse's kids, and their parents. There's a more detailed list in my book, the Self-Directed IRA Handbook, and also on my website, SDIRAhandbook.com. The second thing the prohibited transaction rules restrict is what's called an extension of credit prohibited transaction. And essentially what this is it restricts you from guaranteeing a loan that your IRA would receive. So if my IRA was going to invest and buy real estate and receive a mortgage, like let's say my IRA is going to put down the down payment and get a mortgage for the balance, that's possible, but the loan must be what's called a non-recourse loan. The owner of the IRA, as well as their spouse, kids, parents, the owner of the IRA is prohibited from guaranteeing the loan that the IRA receives. It's called an extension of credit prohibited transaction. So if my IRA wants to buy real estate and get a loan, it can, but I can't guarantee the loan for the IRA. So what happens is there's a number of banks in the industry that have loans for real estate, specifically made for IRAs, where they'll just lend the money on the real estate. And if there's a default, they'll simply foreclose and take the property back to pay off their loan. But they won't go after the IRA, they won't go after the IRA owner. So those type of loans are called non-recourse loans. Those are the loans you'd have to get if you were going to get a loan to buy real estate with your IRA. The next prohibited transaction is called a self-dealing prohibited transaction. And this occurs if your IRA is investing in something and you benefit from the IRA. For example, let's say that you're a real estate agent, your IRA buys a rental property or a property you're going to fix and flip, and as part of the purchase, you receive the buyer's agent commission. Well, if you receive the buyer's agent commission, you're a disqualified person to your IRA, and you've benefited from your IRA making that investment. That would cause a self-dealing prohibited transaction. So you can't personally be making money off your IRA's investments. You also can't have use of the asset. So if your IRA bought a rental property, you can't go stay at it, or you couldn't like lease it to your kids. That would be a prohibited transaction as well. So any investment assets the IRA buys needs to be strictly for investment purposes, and you can't personally be making money off of the deal. Now, if you have a prohibited transaction, the consequence is really disastrous for the IRA. You no longer have an IRA. The entire IRA involved gets distributed. Now, if you have other retirement accounts that aren't involved in the transaction, those accounts are not affected. But that entire IRA that was involved in the transaction is distributed. And distribution of an IRA means taxes and a 10% early withdrawal penalty if you're not yet 59 and a half. So you want to avoid a prohibited transaction because if you do have one, you essentially lose your retirement account. I mean, you get the account, you'll get the money, it's just distributed to you. So, but now you'll just own everything personally, and you have to pay taxes on that distribution of all those assets from the account. All right, now there's a really popular structure used by people to invest in real estate. There's a lot of variations of this. It could be used to buy a rental, it could be used to buy notes, it could be used to invest in other companies or funds on larger deals. But this essentially is called an IRA LLC. Some people call it a checkbook control IRA. But what it is rather than having the IRA buy real estate directly, the IRA will invest and own an LLC. In this case, it'll own it 100%. The LLC, in turn, will go buy the property. The LLC will be on the contract to purchase the property. The LLC will have its own bank account it will use to pay money to buy the property. The LLC will receive the rental income if it's a rental property, or the interest income and principal if it's a note, or it'll receive other profits if it's a larger deal, like say, an apartment complex or a commercial deal, whatever it may be. And the nice thing about the LLC is, as owner of the IRA, you can be manager of this LLC. Now, let's say this is Mat Sorensen's IRA. It owns the LLC 100%. I'm the manager of the LLC. I don't have any ownership of the LLC personally. I'm just the manager. I'm kind of like president of the corporation. I can sign for the LLC. I can manage the LLC's checking account. What will happen is my IRA custodian will invest the cash I designate out of the IRA into the LLC. Now what the IRA owns is it owns this LLC. The LLC in turn owns the property, or it would own the note, or it would own the other company that owns a larger deal. This is popular for people for a number of reasons. One is particularly on a rental property, or if you're lending money and they have lots of notes, or it's a fix and flip. It's easier to manage the bank account. You can cut the checks to buy stuff, receive the income, pay for expenses, and you can do this right out of the LLC. You don't have to go back and forth to your IRA custodian every time you want to do things. So the LLC works well because you can have control of the investments and receive income and pay bills. Now, the nice thing about the IRA LLC is, in this example, it's owned 100% by the IRA. There's no tax return required for the LLC to the IRS. It's called a single member LLC or disregarded entity, so it does not require a tax return. Now, there are restrictions. If you're manager of the IRA LLC, you can't receive a salary, you can't work on the property physically, You still can't guarantee a loan for it. So you have to still kind of keep a distance here and not getting sour, you're doing too much work. But as manager of the LLC, you can make decisions, decide what to invest in, pay for stuff out of the LLC bank account, receive the income, sign contracts for the LLC. That's all acceptable to do directly out of the IRA LLC here. Now there's other ways to do this. This could be a multi-member LLC. You could have multiple retirement accounts investing into an LLC that buys real estate. Some of these could be individuals, some of these could be IRAs, and they're all partnering in on a deal that buys real estate. Sometimes the individual here could be a service partner not putting in cash. Let's say this is my IRA, my sister's IRA, and my friend personally who's doing the real estate deal, and she gets ownership in the deal for providing the services. That would be okay. We could break it up that way. There's lots of variations of this multi-member LLC. Once you get to this structure, though, the LLC is now filing a partnership tax return, and that doesn't cause tax when you file a partnership return, but it's just something, it's now a tax return the LLC has to do every year. But this is a great option if you're trying to pool multiple retirement accounts into one LLC to go buy maybe a bigger investment property. And of course, you could have this on the bigger fund level if you're looking to invest in that, where you may have 50 investors going into one LLC, and you have a fund manager that's buying an apartment building or a larger commercial deal, and you're essentially aggregating a bunch of the money here, breaking up the ownership in the LLC based on the dollars each person or retirement account is putting in. And the IRA can certainly invest in that way as well. Now, there's two tax issues everyone needs to be aware about when they invest their retirement account into real estate. Some people call these a tax trap or a tax, roadblock, but these are just things you absolutely have to know. In many instances, they don't apply, and some they do. So you just got to know when to identify it. Now, if you run into one of these taxes, that doesn't mean don't do the deal. That just means calculate it into what you're doing. We have lots of clients who use their self-directed IRAs. They'll run into these taxes, and they'll still pay them because it's still an otherwise good investment that's efficient for building their wealth. So the first tax is called UBIT tax, unrelated business income tax. And in the real estate world, where this really will come into play is for real estate development, construction, or if they're doing a lot of short-term flipping, like more than just one or two, fix and flip properties a year. They're doing 5 or more, I'd say, where they're out buying property and selling it within a year. If that happens, what the IRS does is they look at these types of things, development, construction, a lot of flips, and they'll look at the IRA and say, all right, this IRA isn't just passively investing in real estate anymore. It's kind of in the business of real estate, and since it's in the business of real estate, it has to pay this UBIT income. Because what retirement accounts are designed to receive is investment income. The beneficial rules on the profits going back to your retirement account, you don't pay tax on it. That's what's set aside for investment income your retirement account receives. If your retirement account, however, receives business income, like real estate development, or you're doing new construction and sell, or you flip a lot of properties, then the IRS moves over into getting business income as opposed to investment income. And when it receives business income, it has to pay this tax called UBIT tax. Now, if you're buying rental properties or you're doing notes that have interest income, those things are always exempt from UBIT, so you don't need to worry about this tax. But when you're in this development, construction, significant short-term flipping, you just got to be aware of this. Get a consult in your situation. Our office, the attorneys here, can certainly help in just kind of guiding you through this to see if there's a way to avoid it in your transactions, or if you do have it, maybe ways to minimize the tax, or at least advise you on what to be expecting as you're self-directing and investing your account. Now, the other tax I want to talk about, and by the way, UBIT is a 39.6% tax rate. It's a really high tax rate, so it's really critical to make sure you're structuring to try and avoid it where you can, or that where you know it's going to occur, that you're prepared for it. Now, the second tax you need to be aware of is a tax called unrelated debt financed income, or it's called UDFI. Now, I know these two things, UBIT and UDFI, are not the most exciting things for a Tuesday to talk about, but they're pretty important as you're self-directing your account. Now, UDFI, we'll see clients run into this more, but I don't think it's the end of the world. What UDFI comes from is Congress basically, when they created retirement accounts, they said, all right, if you want to leverage your retirement account with debt, you can do that. Remember, you can't guarantee the debt. The IRA owner can't guarantee the debt if that's happening. Someone else in the deal, a partner, could guarantee it, or you could get a non-recourse loan, but the IRA owner can't guarantee the debt for their IRA. But if you get debt, the IRS says that you have to pay this tax called UDFI on the profits you're making from the debt in the deal. So for example, if I bought a $100,000 property and I put $40,000 in for my IRA and $60,000 came from debt, the IRS is going to look at that and they're going to say, all right, 40% of this deal is your IRA money, so 40% of the profits go back to your IRA and you don't pay tax. So let's say I made 10 grand. In that instance, 4,000 would go back to my IRA. There's no tax on it because that represents my IRA money. The other 6,000 though, that's debt. That 6,000 I made is attributable to the debt because 60,000 of the deal, 60% was debt. So now I have to pay tax on the debt part. That's 6,000, and you'll pay at this 39.6% rate, this UBIT rate, as you're having rental income. If you sold the property and had capital gain, you get the capital gains tax rate of 20%. But this tax is only due on the debt part of the equation. Obviously, the more debt you have on a deal, the more income gets subjected to this. Now, this is definitely a downside to this, but it's something to just be aware of. A lot of people will still invest their IRA in debt leverage deals, either the IRA buying something itself, then getting a loan, or investing into a partnership or a fund that has leveraged real estate, because the returns are frankly better. You're getting the benefit of leverage on the real estate deal. What the IRS is simply saying is, let's take the 100,000 example here. They're saying, you know what, only 40% of the money was cash from the retirement account. The other 60% was not retirement plan money. If that was you personally putting in the other 60%, the other 60 grand, you would have to pay tax on that 60 grand. That's basically all they're saying here. Is they're saying that money that's the debt part of the deal is taxable money. The cash part that's going to be represented by the retirement account, you don't have to pay tax on. But any part that's debt gets subjected to this UDFI tax. Now, these two taxes, if you run into them, are reported on what's called a 990T tax return. The IRA ends up filing that tax return itself. It's separate from your personal return. We do these tax returns in our office. A lot of clients that have UDFI, you still get depreciation expense, you still get to take interest income and all the expenses on the property. So even for a good cash flowing property, a lot of clients may not even see much UDFI tax because of all the expenses and particularly depreciation expense that can really reduce the income, even though you may have obviously positive cash flow. So just talk to an attorney or CPA on that if you're running into that issue that's familiar with IRAs. It's a pretty common item to be aware of. Most professionals that work in this area are getting better at it, but if your professionals or accountants haven't dealt with IRAs before, they're probably totally unaware of this. So you want to work with someone who's got knowledge on it. It's also chapter 15 in my book, the Self-Directed IRA Handbook. Not to make another plug for it, but there's a lot of comprehensive information on that and how it works. All right, now the last concept I just want to share before we open it up here for questions is I want to talk about using a solo 401k. Now, before we've just talked about IRAs, and most people who use a self-directed IRA are people who already have money built up in an IRA, or maybe they have an old 401k for an employer, and they're just looking to roll that money over and use that money in a self-directed IRA to invest. They're not really trying to grow the account through contributions. They're just trying to roll over and use what money you have. And for those people, a self-directed IRA works well. But there's another option for people who are self-employed that they could use to self-direct, buy real estate, invest in LLCs or funds or notes, whatever it may be. And that is called a solo 401k. Now, if you're self-employed, you can use a solo 401k to invest your money. You can roll over existing retirement accounts. You can make new contributions of actually up to $54,000. And what happens is this 401k is for someone who's self-employed with no other employees. It could just be you and a spouse, or even you and family, or you and partners. But if there's no other full-time employees, you can create what's called this solo 401k. That's basically a supercharged 401k. You make it as generous as the rules allow because the only employees are you and your own family. So, but it doesn't work too well if you have other full-time employees, because then you have to match them in the same way you want to match yourself, and it gets a little complicated and expensive. But it works great for those who are just self-employed, called a solo 401k. Again, you can put up to about $54,000 a year into it as contributions. For someone that has an S-Corp, for example, if you made $140,000, you can max it out, put $54,000 of that into the solo 401k. That's a huge tax deduction for people who are self-employed. And then this solo 401k can then invest into notes, or invest into a fund, or invest into an LLC that owns rentals. I mean, all your self-directed investments are still available directly out of the 401k. Now, in the IRA world, when we were talking about IRAs before, IRAs must have a third-party custodian. So you have to have some other third party that manages your IRA account for you. And there's probably 30 self-directed IRA custodians out there. But in the 401k world, you can self-administer your own solo 401k, and you can be the trustee. So we set these solo 401ks up in our office through our company called Navigator. When we set up the solo 401k under our IRS pre-approved docs, you can self-direct into any of these things: real estate, notes, funds, LLCs, whatever. And you're trustee of the 401k. You can sign stuff. You can manage the bank account directly of the 401k. You don't need a third-party custodian. And this 401k, you can have an account for your spouse, an account for you. You can each be putting away $54,000 a year if you wanted to, if you have that income level. It's really an awesome opportunity for people who are self-employed. But the solo 401k does not work unless you're self-employed. Now, if you have a day job, let's say, and you got your W-2 day job, you don't want to leave, but you have a business on the side, it's possible to still do a solo 401k on your side business, so to speak, as long as you have some earned income over there. And the solo 401k, again, can receive rollover funds, new contributions. It's really a great option for people still trying to sock money away into retirement plans with new contributions. And again, all the real estate investment options are available right directly from the solo 401k. So that's the solo 401k option. The prohibited transaction rules are still the same. You still can't, buy or sell real estate between your 401k and yourself personally. You can't benefit from the investments or stay at them. You can't receive commissions on the stuff that the IRA or 401k buys. The one distinction, though, that 401ks have is when it buys real estate directly with a loan, the UDFI tax does not apply to solo 401ks. So the UDFI tax we talked about, where if you have debt involved, it can raise UDFI for the profits from the debt. That tax, 401ks got an exemption from that tax. The 401k industry's lobbyists are frankly better than the IRA industry, so they got an exemption from that tax. All right. Here's just some details on that. Again, $54,000. These are some of the notes of what we already mentioned here. $54,000 a year you can put in as new contributions. You can roll over as much IRA or old 401ks as you have. You can self-trustee it. There's no tax return required for the 401k until the 401k receives $250,000 of assets. Once you have $250,000 of assets in the 401k, it needs to file a tax. The 401k itself starts filing a tax return, which is called a 5500 EZ tax return. All right, so that is the 401k. Now let's, Dave, let's see back if we have any questions or or anything, I can circle back and answer any questions that may have popped up during the presentation.
Great.
So you let me know what to pick.
We've got a few on that. I want to thank everybody for jumping up on that. Michael, as a thank you for being the first person to ask a question, you will receive a 2-book set, one of the SDIRA handbooks, and Matt's partner, Mark, has a tax and legal playbook that has been just an incredible read, which I just picked up a few weeks ago. Matt, not downplaying your SDIRA handbook. I read it last year. But in combination, both books, if you're dealing with business entities and structure, both books are absolutely terrific. So, Michael, in appreciation of you asking the first question, you have earned a copy of each of those books. So thank you for that. Michael's question is, suppose my 401k wants to purchase a rental property. In the offer contact, does it act as my 401k FBO me? And would I use it, and would I, as the custodian, sign as me, trustee?
Okay, so I presume he's got his own solo 401k that can be self-directed. I'm presuming that here. If your 401k is, an old employer 401k, a Merrill Lynch or Fidelity, it's not going to work. But let's presume you've already got the solo self-directed 401k. Generally, yes, we would list it as, XYZ 401k FBO. Let's say this is mine, XYZ 401k FBO Mat Sorensen. And that way we're designating that this is the 401k for this company, and it's also specifying whose account within the company there is. Now, if there's only one participant in it, sometimes we don't do the FBO. A lot of our clients that use solo 401ks, they'll have an account for them and an account for their spouse in it. So in those instances, we definitely use the FBO. Or if they have a traditional account and a Roth account in the 401k, which you can do also, then we'll use the FBO. But if you only have one pot of funds, that's just one of the owners, and it's just their traditional account, for example, there's no one else there, then you could drop the FBO because you don't need it. But we like to use the FBO so it signifies whose account it is, and if you have Roth and traditional accounts within the 401k, it also signifies whether it's Roth or traditional, because that stuff needs to be tracked. In terms of signing on the contract, you should be the trustee. So in the solo 401k, the way we structure them is the owner of the business is the trustee of the 401k, and so they would be the one signing their name, trustee.
Okay. And Michael does have a solo 401, so that was perfect. Okay. Camilla, welcome back. My husband still has his W-2 job part-time. We own, buy, and hold rentals and have these in an LLC. Can that LLC open a solo 401k? You mentioned earned income. Define whether or not I can open one. Okay.
You must have earned income, and LLCs with rental income do not qualify as earned income. Rental income is passive. It doesn't qualify for retirement plan contributions. So that wouldn't count to justify setting up a 401k. We have had a few clients, I don't necessarily recommend this for everyone, but just to throw one option out, is if you have a lot of rental properties in particular and they're in LLCs, it is possible to do a management company. Usually we'll just do it as a separate LLC or even a sole proprietorship, and have the rental property LLC pay a management fee to the management company. The rental LLC will obviously expense it. Then you'll pick up that income in the management company. You'll need to start running that on Schedule C on your personal return. And now you've just justified an operational business with earned income. Now there's some tax downsides to doing that because now you're going to have to pay some self-employment tax on that income. You're going to have to show some profit. It can't just be at a loss, so you'll run into the hobby loss rules for taxes. But we have had some clients do that, and that's allowed them to adopt a 401k under that management company. Otherwise, we don't usually use the management company structure for clients with rentals. This would be one instance to maybe consider it so that you could justify having the solo 401k.
Terrific. Kathy, can I roll over a rollover IRA into a solo 401k if I don't currently have a business?
No. You'd have to create a business first, or have some self-employment to justify adopting the solo K. And then once you do, then you could roll over the rollover IRA to the solo K. But until you have some business or self-employment, an S corporation is probably the most common for our clients. They're small business owners or self-employed, or maybe even just, again, it could be an LLC that's single member that goes on to Schedule C, or even just a sole proprietorship that's on Schedule C on your personal return. Any of that stuff would qualify. And it doesn't have to be a big business, I mean, we have some clients that may only have $10,000 of income running through that company a year, and they still have to have profit, but it's that's a justifiable, legitimate business. They could adopt a 401k. They may make small contributions. They're certainly rolling over larger dollars. So it doesn't have to be a big business, but you do have to have something that's legitimate, that's real income coming through on the tax return. Otherwise, the 401k gets disallowed.
Follow-up question from Kathy: How long do I have to show business income?
Well, you can set up the new business on day one and adopt the solo 401k on day two. You don't have to have income yet in the business. The issue is, over time, the business is going to need to have income, or the businesses will have to shut down. It'll be subject to what's called the hobby loss rules. If you have 3 years of no income or losses, eventually the IRS starts questioning that business and the purpose of it. And if that happens, then the 401k can get disqualified with it as well. So if you're like, well, I'm going to set up a new company, I'm doing some new business activity, then you can set up a solo 401k on day two. We have a lot of clients that will set up a new S Corp for them, or for a new business that they're starting, and then we do the solo K on day two. That's okay. You could do that. But the question is, I just want to make sure that someone is really going to follow through with the business. We don't want someone setting up the new company, adopting the solo K, and then have no intention to really go out and start a business, because then they're going to get a couple years down the road and the IRS is eventually going to start disallowing that business or any expenses or losses in it, and then they could possibly disallow the 401k too.
A follow-up from Camilla. She's the one with the husband that still had the W-2 job, and asked about the passive income opening a solo 401. Follow-up question is, okay, how about if I have an LLC that I have used to assign properties for an assignment fee? What if I don't actually make income in the LLC every year, but maybe every other year or every 2 years?
Well, that's possible. You'd want to have income you'd need to at least have activity in there each year. Presumably you'd have some expenses and some income each year. If it's rare that you have, an assignment fee or commission or wholesale fee, whatever, come through, if that doesn't happen a lot, then I don't know, you just have some risk. You have more risk that business is going to be disallowed. We're more keen on this in the situation where you've adopted a solo K. If you were just coming to me saying, yeah, I'm just going to run this through Schedule C, and you're not doing a 401k, we're not as concerned with this issue. We're like, great, we'll just show it when you have income, not show it when you don't. Maybe you take some expenses in a loss 1 year when there's nothing that closes or goes through. But next year you get 2 assignment fees each for $15,000 and you have $30,000 of income all of a sudden. That's okay. But what And if that happened, if it played out that way where, you know, you had 2 deals go through 1 year and you had some decent income, and then the next year you had 0 and you had 5,000 of expenses, then that's okay. You're going up and down as long as you're trending upward and you're having positive income year to year. The only thing I'm cautious about is that business having no activity for too many years, at which point you may have to make the 401k dormant, close it out, and roll the funds out somewhere else. So you want to have kind of a long-term plan. Try and show consistent income if you can. If it's not possible and you want to try and run what income you can, assignment fees, whatever it may be, you can try that. It's not the most ideal way to do it.
From Jack, I'm planning on starting a non-real estate LLC in technology, but would like to use some of my self-directed IRA funds to fund the business. I'm worried that this could be a personal gains situation. That if the IRA is the sole owner or partner in the LLC, is that acceptable?
Okay, yes, very problematic area. There's a couple of different ways you can go on this. I, in fact, wrote an article called Starting a Business with Your Retirement Account. That's on my blog at SDIRAhandbook.com. The first option I want to say is, one thing you may want to do is, usually it could be an LLC. A lot of our small business private company clients use S corporations just because they have a better tax deal than LLCs on operating businesses. But let's say you start the new company, the new tech company, it's an LLC, it's an S corp. And what I would probably do, if you only need 50 grand, the first and easiest way is set up a solo 401k, roll over your self-directed IRA money to the solo 401k, and you can loan out half the balance of the solo 401k to yourself, not to exceed $50,000. So if you have $100,000 in your solo 401k, you can loan yourself out 50 grand to use whatever you want. You can, put that back in the business to fund startup expenses, buy inventory, pay some new employees, whatever it may be to get things off the ground. That can at least get you 50 grand. Past that, there's some other structures called the rollover on business startups that allow you to work in the business. But I'd kind of look at those two things. We really like just doing the $50,000 loan if that's all you need, or if that $50,000 can help. And if you need more than that, though, you want to look at something called the ROBS, rollover on business startups, which we don't do those. But there's some companies out there, Guidant and Benetrends, who do those structures. Those are just much more restrictive, much more costly. You're going to pay at least $5,000 in fees to pull that rollover on business startup structure off, where you use retirement account dollars and you work in the business. Otherwise, IRAs are designed to own businesses that, like own investment income, like notes or rental real estate or an apartment building. That's the type of stuff that retirement accounts should receive income from, rather than an ordinary income business like an LLC, because that'll cause UBIT tax. And then also you can't work in the business. So I would look at the ROB structure, but I would first look at the just trying to get 50K and doing the 401k loan.
Great.
And we can walk through that if you want to give us a call. I know it's a little technical. I spent way too long explaining that, but I was trying to give you enough info to know where to go to proceed.
Quite good. Questions are starting to pour in pretty good now, so this is going good. From Mike, you mentioned UDFI is exempt in a solo 401k. What about UBIT?
Good question. The exemption is only limited to UDFI on rental real estate. So the UBITs part still applies for 401ks for flips or development type activity.
Okay. Monique, thanks for joining us today. what would be the benefit of rolling over an IRA to a solo 401k? It's a traditional IRA to a solo 401k.
The benefit, it just depends on what you're investing into. If it was leveraged real estate with debt, you could at least avoid UDFI tax. So that could be a benefit for the 401k IRA. But the other benefit I would just say is if someone's self-employed and can do the solo K and they want to keep making new contributions, I think the solo K is a good way to go because you can make new contributions to the solo K and you can roll over prior accounts. So you can just keep it to one account, you know. So if I have this solo 401k here, I can be making new contributions to it at a much higher level than an IRA. You know, it's actually $54,000 now. That pulled an old slide apparently. But you can put $54,000 a year into the 401k from contributions depending on income. Whereas an IRA, you can only put $5,500 in. So you can't really grow an IRA very well through contributions, but you can a 401k. But also the 401k allows you to roll over your other accounts. So you could really consolidate all the money into the 401k, your existing rollover dollars from your traditional IRA or your prior employer 401ks, plus you could be the mechanism where you're making all your new contributions. Now, if on the other hand, you're like, you know what, I'm not investing in stuff with debt, I'm not self-employed, I just want to work with the money that's already in the IRA and invest that and get a return, just do an IRA. It's easier, it's cheaper. You don't really need the 401k. It's not going to be any benefit to you.
Thanks. Kathy, once solo is established, though, with a profitable business, if I shut down the business after 10 years in order to retire, can I keep the solo forever? Can I roll it into a current active 401k into the solo when I stop my W-2 job?
Yes, so once the business that's created the 401k ceases, what happens is the 401k kind of goes into this dormant 401k type status where you can work with the money you already have, but you can't make new contributions to it. And that would apply if you had a good 10-year run on it where you would be okay. The IRS would still allow that 401k to sit around and invest and own stuff. And you could roll it out to an IRA if you wanted, or you could keep sending it, you know, investing it out of the 401k. Even though the business is shut down, the 401k could still exist independently with no new contributions. One thing, though, you couldn't do that you want to be careful about is if you set it up for only 1 year or 2 years and then shut down the business and try to keep operating the 401k for many years past. That's going to be looked upon with much more scrutiny from the IRS. But if in your example, if we just went straight to that, you had it for 10 years, you operated it, and then you shut it down, then I think you'd be fine. Just continue to use that 401k in a kind of what we call a dormant status where it doesn't have new contributions, but you just keep investing the money there. Or again, you could roll it to an IRA or set up a new business that has a new solo 401k that you rolled the old solo 401k into. There's some few options there.
And prior to the retirement, she could add an active 401k from an employer as an additional contribution, or once it's set up, it has to be run in contribution strictly from the business?
No, absolutely. It could receive the rollover. So if she left that corporate job or whatever with, you know, the W-2 employer and rolled over that 401k, you could roll over that prior employer 401k into the solo K. Absolutely.
Great. Michael, suppose I want to take only partial distributions from the rental property in my IRA. How can I, quote unquote, move in?
Oh, you want to use the property personally? Move into the property?
I'm thinking that's what he means.
Okay, all right. Yeah, in order to, this question is basically about how do I have personal use of a property. Some people have bought property with their IRA and they're like, actually, I want to live in that property one day. And so it's a rental for now, but later they want to live in it. You have to fully distribute the property. So if you went and moved into it and your IRA owned it, that would be a prohibited transaction. So you don't want to do that. if you just start taking distributions, you can do that. Some clients like to take distributions over time. So they'll take, let's say the IRA owns the property 100%, so they'll maybe take half out in 2017 and they'll transfer title from their IRA to them personally. Now they personally own 50% of the property and the IRA owns the other 50%, and then next year they transfer out the other half and distribute that from their IRA to them personally. So after 2 years they now own the property 100%. But some people do that because they want to break up the distribution over 2 tax years so the income doesn't fall all into 1 tax year. Or you could be doing this over 3 years or whatever. I'm just giving a 2-year example. When you're doing that strategy though, which sounds kind of like where this question's from, is you have to wait until the property is fully distributed to you personally to live in it. Unfortunately, you can't move into it midway through. You have to wait till the whole thing's distributed and owned by you personally.
Great. Alden, thanks for joining us today. As a self-employed farmer, I don't have an entity set up to run my business. Are there benefits I'm missing out on? And if so, which entity should I look into running a solo farming operation from?
Ooh, great question. You may want to look at an S Corp. You may want to look at an LLC. We have some experts in our office, CPAs really, that have a lot of farming clients. So I'd recommend a tax consult with one of them. If you call my office, just call the number here and ask for Liddell Air. He's a CPA in our sister accounting firm. He has a lot of farming clients and has a lot of great tax strategies. So that'd be a good place to go. I don't have that many farming clients, but Liddell does. He has some rather big clients and kind of some smaller operators too. And there's some unique tax planning for farmers. They frankly have some beneficial provisions in the tax code.
And Kathy, can the full $54K contribution be paid as after-tax dollars like a Roth?
Yes and no. Let me go back to that slide. Again, this is $54,000 here. When you put money into a solo 401k, there's 2 ways you put money into a 401k. And if you think of your corporate 401k you may have had, or you're through W-2 job, there's the money you put in as an employee, and then there's the match that the company puts in. Now this 54,000 number here that we're talking about is a combination of both. The way it works is the employee, if the employee makes at least $18,000, the employee can put in $18,000 into the 401k. On top of that, the business can match and put in a total of 25% of that person's income. So for example, let's say I made $100,000 from my business. Let's say it was my S Corp and I got a W-2 for $100,000. I could put in $18,000 as the employee contribution. I only had to make 18 to do that, so I put in 18. Plus, the company can put in 25% of what I made as a company contribution. So now the company could put in $25,000. Now total, I've got like $43,000 in there off of $100,000 of income. Now, but just it takes about 140 to get the 54,000 number. But let's just stick with 100 because it's easier to do the math. So I had 100,000 of income, 18,000 went in as the employee, 25,000 went in as the employer. Now the employee contribution can be Roth. So you just elect when you make the contribution. There's a form you'll fill out, when you're doing it in your own solo K, and you'll set up a separate bank account in your own solo 401k for Roth dollars, a separate bank account for traditional dollars, because you need to track those 2 sets of funds separately if you're doing Roth and traditional. But let's say you wanted to do everything as you could as Roth. So the employee contribution, the $18,000 is easy. If you make $18,000, you can put in $18,000. And you can elect whether that's traditional or Roth right from the get-go. Now remember, if it's Roth, you're not getting a tax deduction when you put in that 18. So let's say I did 18 Roth. I didn't get a tax deduction, but now I got 18,000 in my Roth account. Now the company is going to put in the other 25,000 here in this 100,000 example. When the company puts in that $25,000, that is traditional dollars. The company contribution always has to be traditional dollars. The company cannot put in Roth dollars for the match part. The reason is the company takes an expense for that on the company tax return. So, this is your company. You're going to get a $25,000 expense on the business return, which reduces your profit in the business. So it goes in as traditional dollars into the 401k. The company expensed it. Now what you can do is you can then convert that, though, that $25,000 into Roth 401k dollars. So you'll convert that $25,000 from traditional to Roth, and you'll essentially have to pay tax on the $25,000 that you've converted. Now remember, you got a $25,000 expense in the business, and now you're converting it and paying tax on $25,000 of income. So it's kind of a wash in the end. In the end, you really didn't get a deduction on the 18 or the 25 because the expense of the business and then the conversion that you have to pay tax on washes out. But it's kind of a two-step process to get the employer match as Roth dollars. But it's possible. I love Roth. A lot of our clients love to use Roth accounts. So if you want to maximize those dollars of what you're contributing, you have to do that Roth conversion. And there's a form you got to fill out when you do the conversion. You have to do some tax withholding on it too, unfortunately. But that's how it works if you're trying to maximize as much Roth as possible.
Great. That concludes the question. I have one other topic I'd like to ask you, Matt.
Yes.
We have another webinar coming up in 2 weeks. Specific to asset protection and business structure. If you have a minute to give a couple of teasers on what is going to be covered and the value of it to a real estate investor, we'll see what we can do as far as getting some people back online with us.
Yeah, absolutely. What we'll talk about in that is how to protect your assets, or can I go over like business structuring 101? Where we try and break stuff down in your life into operational income and investment income, operational assets, investment assets, show you what entities to use in what type of situation, and then also break down how those different types of assets and income are taxed. Because different types of things you're doing are taxed differently. And so the entity you use is also unique for the tax side of things. So good asset protection planning is using the right entity to protect yourself from liability, but also taking into account the right tax planning when you're using that entity. So we'll be hitting tax topics a little bit too. And we'll be doing more tax topics later in subsequent webinars, but we'll go over the different entities, LLCs, limited partnerships, series LLCs, when to use an S-Corp, when to not, and we'll just try and break it down. Let's talk about trusts and when to use trusts and how they should be incorporated into your business and asset protection plan.
Matt, thanks again on that. For everybody who's attending today, you will get a recording of the webinar automatically, including the handout. Replays will be available via sign up for those who weren't able to attend. We have the next webinar coming up in 2 weeks, so please visit directsourcewealth.com on the events page and be sure to sign up for that. The sign up page should be active by the end of the week for the next one. Beyond that, I just want to take a moment to say thanks to Matt for joining us, and thanks to everybody who was able to be here today. This was a fantastic list of questions and on a topic that's near and dear to a lot of our investors. So we'll see you all in 2 weeks.
Thanks, Dave.